Hello everyone. Thank you very much for attending our meeting despite the warm weather outside. I would like to explain to you the first half results as well as situations of our business. This is the actual results during the first half of the year. First, sales. While the underlying sales grew positively, the net sales went down by 6% year-on-year due to foreign exchange. The underlying sales grew by 3%, while FX had negatively affected the sales by 9%. Operating income declined by 2% year-on-year. I will explain this in more detail later, but there are three important factors to note here. First, motorcycle business in emerging markets grew slightly despite the declining scale and currency impact. Second, business in developed markets dropped due to foreign exchange. Third, investment in development increased. Net income was 62% of last year's result. Because operating income declined by 8 billion yen, mainly due to the currency valuation losses as of the end of June. Actual FX rates during the term under review are shown here. Here is the breakdown of sales and operating income by business segment. As I mentioned earlier, currency impact to net sales was almost 75 billion yen. And operating income was positive across all the business segments. This slide shows how the operating income changed from last year, shown at the far left, to the actual this year, shown on the right. I would like to point out three factors here. First, operating income of motorcycle business in emerging markets was 16.6 billion yen. Profitability improvement exceeded the negative impact of weaker currencies in emerging countries by 10 billion yen and weaker profit due to decline in volume. As a result, operating income increased by 200 million yen year-on-year. Business in developed countries, on the other hand, generated sales of 52.5 billion yen. Profitability improved. However, as the underlying sales increased, expenses increased, and currency was a negative factor by 1.1 billion yen. As a result, the sales declined by 4.4 billion yen year-on-year. Thirdly, investment for growth strategies increased by 3.7 billion yen year-on-year during the first half of the year. In a nutshell, 4.4 billion yen decline in developed markets and 3.7 billion yen increase in investment for growth led to the year-on-year decline at operating income. Next, this is our full year forecast. While there are a lot of uncertainties in the currency market at the moment, for the second half of the year, based on the assumptions of 100 yen to a dollar and 110 yen to a euro, we will strive hard to generate stable earnings. To be a bit conservative, full year sales is projected to be 1.5 trillion yen, operating income 105 billion yen, with the operating income margin of 7.0% and net income 60 billion yen or flat year-on-year. Dividend is expected to be 60 yen per share, so the payout ratio would be 35%. Since we are expecting to achieve stable profit into the next fiscal year, and we would like our dividend to be stable as much as possible. Our EPS guidance is 60 yen for this year. ROE is expected to be 12.6%. Net income ratio should improve slightly, and total asset turnover ratio will stay almost flat. And equity ratio is expected to go up by 2 points. Therefore, we believe ROE will stay flat year on year. So this is the revised forecast for the year. I would now like to give you more details about operating income. While contribution of profitability improvement to operating income in emerging and developed markets in total is expected to be 36 billion yen, that of currency is expected to be negative 49.3 billion yen. Profitability improvement would not be large enough to offset FX impact. Expenses will slightly go up, and development investment for growth strategies of 8 billion yen is factored into our plan per our original budget. This is the full-year projection for operating income. To summarize, in the second half of the year, based on the assumption of 100 yen to a dollar and 110 yen to a euro, we intend to secure stable profit. And we believe profitability improvement will continue further next year. To be more specific, in emerging markets, if the foreign exchanges remain at the current level, the impact of currencies should become positive. Since there is a time lag of about 3 months before the current rates are to be reflected to our numbers, negative impact will still remain in the second half to some extent. However, in the next fiscal year, it should be reversed to a positive impact. Also, we will introduce new products from the second half of the year. We have exciting products in the pipeline for next year. And while we continue to reduce cost in conjunction with new products, we expect unit sales to increase in some markets, i.e. India, Vietnam, and Thailand. As for Indonesia, we still have to wait for economic recovery. Next, in the developed market, based on the exchange rates of 100 yen to a dollar and 110 yen to a euro, negative impact of the currencies is expected to linger into the first half of next year, and the baseline should finally become consistent in the second half for year-on-year comparison. But overall, we believe the impact of foreign exchange will become more stable next year. In the more stable environment, we are planning to introduce various new products from different business segments. And since we are executing the inventory correction as much as we can this year, the inventory correction should be completed and sales should increase in the next fiscal year. So overall, as the currency impact becomes more stable, profitability should continue to improve further. Next, cash flow. As we implement ROE-oriented management, we have been working to improve our cash flow this year. As you can see, in the first half, the cash flow turned positive, and it is projected to stay positive for the full year. Because first, we are expected to secure stable profit, and working capital position is also improving. And we're planning to pay dividend, and budget for growth investment has remained unchanged from the original plan at 40 billion yen. This is our current financial condition. I will next like to give you more details about our business by segment. First, motorcycle business. To give you the context, let me share with you the overall picture in the motorcycle market. During the first 6 months of the year, global total demand stayed almost flat year-on-year. Against this backdrop, our retail sales unit increased by 1%, and wholesale unit decreased by 1% year-on-year. 1% decline is within the margin of error, and we are making conscious and thorough efforts to align wholesale shipment to retail sales this year. For your reference, excluding Indonesia, wholesale grew by more than 10%. So the performance in Indonesia is affecting the overall result. Now first, ASEAN. 3 countries, Vietnam, the Philippines, and Thailand, performed quite well. Total demand increased by 9%, and our sales grew by 21%. In Indonesia, as the total demand declined to 84% of last year, our wholesale became 78% of the previous year's result. But our retail sales were 84 or 83% of the last year's actual, so we are waiting for the market recovery. Due to the promotional platform and improvement of product mix, profitability continued to improve in all the markets, including Indonesia. While sales is declining there, profitability continues to improve, contributing to profit growth. As you can see here, wholesale was 143,000 units, slightly down from a year ago, but this is attributable to Indonesia. As a result, sales declined slightly, but operating income margin improved, nearing 8% this year. Popular models this year include N-Max, based on water-cooled 155cc automatic platform. This model is manufactured in Indonesia and being rolled out globally this year. Another one is M/, based on water-cooled 150cc street platform. This is an ASEAN sport model made in Thailand. Centering around these 2 models, we have more high-end products, and this product mix is reflected in this operating income margin. This is our product strategy in ASEAN. We started to promote new monozukuri based on the platform concept about 4 years ago, and we are finally seeing the effects of the strategy in FY16. Simply put, this strategy is to develop solid platforms and consolidate more models on the platforms. I earlier showed 2 examples, but we have successfully developed hot ASEAN models based on the platforms and advanced them further to become global models. This shows the planned production volume of platform models in ASEAN and that of global models. As you can see here, the proportion of these models will increase further next year. This is our current ASEAN strategy. Next, India. While the market slowed down somewhat around the year 2013, it made a recovery and the market is strong at the moment. Total demand increased by 11% to 8.7 million units in the first half, and it is projected to reach 18 million units by the end of this year. And our wholesale increased by 43% year-on-year. While we traditionally focused on urban areas for sport and scooter business, we expanded our focus to include rural areas for mass market business. Also, our factories in both North and South are now up and running fully, and we succeeded in cost reduction and business efficiency improvement. Including export, shipment volume amounted to 441,000 units during the first half, and sales are as shown here. Export volume declined slightly, particularly to Latin America, and in yen term, export sales also decreased, but as you can see here, domestic sales increased steadily. We have been working to lower the break-even point while increasing production volume, as indicated on the right. The effects of these two initiatives are about to surface. Last year, in FY15, after Chennai plant in South was launched, we suffered from initial troubles and floods, which resulted in some losses. But this year, the production volume has exceeded the break-even point and is expected to contribute to profit next year and the year after. Next, moving on to developed market. First, motorcycle business. The markets in the 5 countries in developed markets are stable, generally speaking. In particular, Europe grew steadily through the first 6 months of the year. And we demonstrated strong presence in the market, growing the retail sales by 5% year-on-year. This is because we have been reinforcing product offerings in each model brand, and some brands are now leveraging global brands. Also, in the United States, inventory reduction and finance business showed good progress. Wholesale unit declined slightly from last year. So did sales due to currency impact and inventory reduction. But we are pleased that we demonstrated strong presence in the market. Next, marine business. Markets in North America and Europe continue to be stable, and our unit sales grew by 5% year-on-year. As I have explained for the past 2 years or so, sales of large engines continued to grow. Just singling out the large engine category, the wholesale unit increased by 10% in North America and by 13% in Europe. This is because boats themselves are becoming larger in scale. Also, as technologies for outboard motor advanced, more boats are switching to outboard motors increasingly. As we explained in connection with the midterm plan, we are currently working to advance our business model to become a system supplier. As you can see on the graph, due to currency impact, sales decreased slightly year-on-year. However, operating income margin was 22.5%, which indicates that our profit structure is now being reinforced to be able to absorb currency impact. The picture here is SR320, which we launched in Japan. This offering consists of our boat, engine, and maneuvering control technology with further technological potential. And this is one of the models which symbolize the future direction of Yamaha Marine aspiring to become a system supplier. Next, RV. If I may comment specifically about ROV. Over the past few years, the market kept growing steadily, and this year, the market growth slowed down somewhat, but it is still a solid and stable market. During the first half, while the market grew by 5%, our unit sales grew by 41% year-on-year. As we have explained consistently on the product front, our strategy is to reinforce our offerings in sport category while solidifying our presence in the multifunctional and recreational categories. Last year, we launched YXZ 1000R manual shift model, and in June this year, we introduced paddle shift model, which is an attractive addition to our product offerings based on our controlling technology called YCCS. This is the first technology of this kind in the industry. Sales were as shown here. Now, I would like to introduce to you 3 growth strategies that we have been working on amongst others today. First, we will enter into the agricultural market in the United States. As we announced today, together with Yanmar, based on the alliance agreement for ROV business, we develop products and will start supplying products to Yanmar in December this year. With this, we will embark on a new business in order to offer new values to agriculture and utility markets in the United States. The picture here is the first product that we will supply to Yanmar. Next, UMS or unmanned system. Following the acquisition of FAA aviation permit last year, the pesticide spraying permit in the state of California was granted to us earlier this year. Now that we have all the permits necessary, we will begin our business. Over the past 3 years, we have been engaged in joint study with University of California, and since the expertise for spraying in California vineyards is well established, we will begin this new business. The picture here is Napa Valley. We believe we can offer highly effective solution. Secondly, pass. Our goal here is to expand customer base from the senior and families to increase more youth in Japan. And internationally, now that we have stronger presence in Europe, we would now like to go to the US market. During the first half of the year, the shipment volume of drive units amounted to 223,000 units, and sales are shown here. We believe this is going to become an approximately 30 billion yen business this year. The chart on the right shows age distribution of our customer base in Japan, with horizontal axis indicating age of our customers. Green line is the age distribution in 2005, and blue is last year in 2015. We plotted approximately 100,000 customers who bought pass last year. As you can see, we have been traditionally strong in the 65-year-old plus senior cohort, and this cohort has been steadily growing. The next largest cohort is around 35-year-olds, predominantly homemakers, but those with commuting demand. This group grew significantly. Now, what's notable over the past 2 years is that 15 and 16-year-old cohort grew so sharply over the past 12 months. This is because here in Japan, many children acquire new bicycles when they enter high school. Pass was not well positioned for the cohort. However, as a result of our targeted marketing and product development for this potential group over the past 3 years, the level of awareness and unit sales have improved substantially. We will continue to target around 16-year-olds and college freshmen in our marketing approach to expand customer base in Japan. There are 1.2 million pupils in one grade overall in Japan, so we will proactively develop new market. Last but not least, IM. The idea here is to develop a solution business which expands our customer base and connect our customers. For surface mounters, we have been traditionally strong in multifunctional category. We tried to enter into high-speed segment once, but due to product issues, we weren't successful 3 years ago. Now finally, we have our revenge model prepared, and we will make a full stride into the high-speed category. As for robots, our goal is to provide the only and first total solutions in the factory automation market. For FA line, there are various types of robots and conveyors involved, and our company has a full suite of products. We now want to integrate them all, control them, and connect them to IoT. For mounters, technological developments are currently underway to connect mounters to IoT. In the first half of the year, surface-mounted market was slow, especially in China. Some companies are now withholding their purchases, particularly in the wake of Brexit. And the overall market was almost flat. However, from the second half, these two product groups will actually be launched in the market. Zeta R is by far the faster model, with best-in-the-world performance in 3 areas. To give you one simple example, this machine is capable of mounting 200,000 chips per hour, or 56 chips per second. These are the important drivers of our business in the second half of the year and toward next year. I would like to conclude my presentation today by showing you a video on Zeta R for 20 to 30 seconds. The one on the left is the model currently available in the market. We can still see heads on the left, but the heads are almost invisible on the right. Since the speed is almost 2 times faster, the left model is currently the fastest in the industry. Chips are 0.4 millimeter thick. The machine on the right is capable of mounting 200,000 chips per hour, while one on the left only 100,000 chips per hour. This concludes my presentation. Thank you.